Today we're going to go over a somewhat famous bet within the investment community that you may or may not have heard of, but I think the knowledge gleaned from the bet and the result will certainly help you in your investments. So this was a bet that was first proposed by Warren Buffett, Buffett being over there, in 2007, and his basic bet was that over a 10-year period that a stock index would outperform any and all hedge funds, including their fees. So a company called Protege Partners, this fellow's name is Ted Sides, I'm not sure how to pronounce it, but he was one of the partners of Protege Partners. They accepted the bet, and the bet was basically each party had to put up the equivalent of $1 million. It wasn't actually quite $1 million because they put it into bonds, and so therefore was a little bit of differential letting the interest accumulate. But the net was that at the end of, let's see here, 2017, December 31st, the winner would be able to designate those funds to go to a charity. So this is the details of it, and it was held by a company called Long Now, held the funds, or the bonds in this case, and ultimately we'll see who was the winner and how it went down. So here's the final results. You'll note that there's actually 5 different funds here, and this is because Protege Partners is not a hedge fund in and of itself. It's called a fund of funds, meaning they take funds from investors and then they allocate that to several other individual hedge funds, and the idea is to make kind of a more comprehensive portfolio of funds. So that's why you see the fund of funds A, B, C, and D. The first year, 2008, the S&P had a very large crash, down 37%, probably one of the greatest of all time, hence the Great Recession. And hedge funds, in this case Protege Partners, did better, comparatively speaking. They were only down 23.9% versus the 37% for the S&P. Hedge funds doing, part of what the argument for hedge funds is that they are hedged, meaning they will keep a short position and therefore benefit in terms of market downturns. So, but what happened is after that first year, even though it was off to a very bad start, the S&P just steadily went, and ultimately turned out to be the winner. Let's look at the final results. So S&P 500 up 125.8% over 10 years. Hedge funds, in this case Protege Partners, up 36%. And of course what we see here is Long Now presenting the money, $2.2 million, to Warren Buffett's charity of choice, which is Girls Inc. of Omaha. So some important takeaways from here. I'll let Warren Buffett's quotes kind of summarize that. But what he was saying was that making money in the stock market does not require great intelligence, a degree in economics, or familiarity with Wall Street jargon. What is needed, however, is the ability to ignore mob panic and manias. Certainly 2008 was very much the definition of a stock market panic, but focusing on big, what he calls easy decisions, in this case simply moving money into index funds, and avoiding short-term activity. So in other words, the commissions, the spread or bid and ask and so forth that's involved with short-term trading can be damaging to your long-term wealth. So the summary, short-term turbulence aside, you want to benefit from letting the market steadily gain in value over the longer term. And of course this completely ties in with the other video and discussion I made, which was the silk investing, which is stock index investing but with a twist, and the twist being adding some leverage to that and of course allowing it to compound over the long term. So this is a good takeaway in terms of the power of longer term index investing and the power of compounding. So hope this information is helpful for you. We'll see you in the next video.